So now let's talk about revenue recognition in more detail. We talked about revenue recognition a little bit in an earlier video. Now let's spend a little bit more time talking about it. So remember we talked about how Amazon.com received $20 for a book order on December 29th, 2014, but it could only record that as revenue once it was shipped about a week later. According to the revenue recognition principle, a company cannot record revenues until those revenues are earned. That is, until that order is shipped to a customer and the collection from that customer who used a credit card is reasonably assured. So deciding when to recognize revenue can be far less straightforward for some companies than it was in our simple example. How should a company like Boeing, who is engaged in long-term projects, recognize revenue? What about companies like Apple that bundle hardware with software? When should they recognize their revenue? So let's talk about multiple deliverables. Apple is actually a perfect example. For sale of bundled products, companies should assign individual values to each of the bundled products. And that's especially important for those of you who are going to be looking at analyzing the software industry. Imagine hardware bundled with software like an iPhone. Certainly when you buy your iPhone, you're not just buying hardware. You're buying the rights to a whole bunch of software, all those software updates that you get rights to. Those certainly have value. And under GAAP, we have to recognize that value. So in the real world, Apple sells their iPhone for $499. And Apple estimates that the standalone selling price for the unspecified software upgrade rights, implicit when a customer buys an iPhone, even though they don't sell you directly those software rights for a special price, they bundle it into that $499. Those software rights certainly have some value. And Apple, on their financial statements, in their footnotes, identify that they have ascribed a value of $25 to those implicit software upgrade rights, which will come in the future. So the way that we have to account for that, or the way that Apple accounts for that under revenue recognition rules, is they immediately recognize the difference between $499 and $25, the $474 or so, which is tied to the hardware. And then they recognize the remaining $25 in future unspecified software upgrade rights evenly over several years. So they don't recognize the full sale of the iPhone up front, the full $499. Only a portion of it, certainly a large portion of it, but only a portion of it. Let's talk about long-term projects. For long-term projects like that Boeing example that we gave, where they're delivering airplanes over several years, companies do have some flexibility with respect to revenue recognition. They can choose what's called the percentage of completion method, which basically allows them to recognize revenue on the basis of the percentage of the total work completed during the accounting period. And the other option is completed contract method. And that's rarely used in the United States, but this method allows for revenue recognition only once the entire project has been completed. That's a far more conservative approach. In the United States, percentage of completion for long-term projects is used much more frequently. At this point, let's go through another exercise and make sure we understand revenue recognition in a little bit more detail for long-term projects. So on January 12th, 2015, Boeing agreed to deliver 6 Boeing airplanes to Bavaria Aircraft Leasing for $330 million. Delivery of the airplanes begins on July 2015, so six months later, and extends through 2017, so we're talking about 2 years. Boeing is paid upon delivery of each plane. Assuming Boeing uses the percentage of completion method, when should Boeing recognize the $330 million of revenues? So again, let's hit pause, give it a shot yourself, and when you're ready, hit unpause, and we'll talk about it. So the answer is throughout the 2017 period as Boeing delivers the planes to the customers. And the key thing to take away here is it's not going to happen when all the planes have been delivered. It's not going to happen when the delivery begins. It doesn't matter when the cash is actually received. What matters, and this is under the percentage of completion method, is that revenue is recognized as Boeing is actually delivering the planes to the customer. So the matching principle inquires about when you associate expenses with the revenue. So when should Amazon record the costs associated with procuring the book that it sold? When should Boeing record the costs associated with producing those 6 airplanes? And the matching principle, as we've talked about, says that expenses should be matched to revenues, meaning that the costs of manufacturing a product are matched to the revenue generated from that product during the same period. So when the product is sold, we then identify the cost. Even though you may have bought the stuff that you need in order to manufacture a product long before, you only recognize the expenses on your income statement when the revenue from that product is actually generated. So in our Amazon example, the cost associated with the procurement of the book must be recorded in the same period as the revenue from its sale. It doesn't matter that you actually bought the book from a publisher, that Amazon bought the book from a publisher a year before. In the Boeing example, the cost associated with the production of the airplanes must be recorded in the same period as the revenue from their sale. It doesn't matter that Boeing probably started buying up raw materials and started work in process on those materials long before the revenue was actually generated from the sale. And so really putting that together is the concept of accrual accounting. Revenues are recognized and recorded when an accounting exchange occurs, while expenses are recognized when the associated revenues are recognized, not when the cash is exchanged. So the question that you should be asking is, what would happen if we just recognized expenses when they're incurred like revenue? So what's wrong with that? We touched on it earlier, but I'm going to keep getting back to this again and again, that accrual accounting does something that cash accounting cannot. So in the Boeing example, Boeing presumably had to purchase raw materials like metal, plane parts, whatever, some time ago before any revenues from its contract with Bavaria Leasing were recognized. And if it recognized them instead of matching revenues with expenses, if it recognized them immediately when it bought those raw materials, the financials would show a company with high costs and no revenues, at least originally before the revenues were received. This, of course, would not be an accurate depiction of the company's profitability because we know that Boeing bought those raw materials for the purpose of fulfilling an order which will generate future revenues. So if you were an investor trying to understand what's going on with this business and you were only looking at cash accounting, you would see for a full year lots of expenses and no revenues that correspond with them. You would get the incorrect impression that the business isn't doing very well. Matching enables investors to look at financial reports and say and understand how revenues are matched with expenses. So the matching principle specifically and the accrual concept are striving to accurately depict a company's operating results. Although the benefits of accrual accounting should be apparent, it does by definition have the limitation that analysts just can't track objectively what's going on with cash, which is a massive limitation. Understand that public companies are required to show an income statement using accrual accounting. So the way that we address this glaring problem that we don't understand what's going on with cash when we look at an income statement, the cash flow statement is a required financial statement, and that enables us to reconcile what's actually going on with cash. Note that cash accounting is not allowed under GAAP, but for tax reporting, certain businesses, usually smaller businesses, are allowed to use the cash basis. Cash accounting objectively recognizes revenues when cash is received and records costs when cash is paid out. It's very straightforward, whereas accrual accounting involves subjectivity in regards to the allocation of revenues and expenses to different periods. In the U.S., by the way, IRS does allow cash accounting for businesses with under $1 million in revenue or up to, in certain circumstances, $10 million in revenue. Otherwise, it's all accrual. So here we lay out a summary of the things that we've talked about. And the key takeaway is under accrual accounting, which is the accounting rules that we are going to be dealing with, some revenues and expenses are reported in periods that are different from those in which the cash was actually received or spent.